important is this August employment report going to be as to whether it remains a possibility that we get 50 basis points?
I think that's really the key factor. We heard from Powell, we heard from the minutes that they will be cutting, but the decision about 25 versus 50 has been deferred to that report. We've now seen the unemployment rate come up enough that it's hard to sweep that under the rug. There's some ambiguity about both how many jobs are we creating every month and how many are we going to need to create going forward to keep up with labor supply growth now that immigration is slowing. So I think we'll learn quite a bit. Our assumption is that the August employment report will look better than the July report. Maybe some of those temporary layoffs in July come back so that the unemployment rate comes down. And job growth, we think, is trending closer to 150 than the 114 we saw last month. If that's right, then I feel pretty confident that the FOMC will go ahead with a 25 basis point cut. They're not thinking in terms of 50 just yet. But I think we heard very clearly from Chair Powell at Jackson Hole that their tolerance for further labor market softening has run out. And if I'm wrong and the August employment report is worse than we think, then I think a 50 basis point cut would be likely.
Interesting. And where does all this take us? You know, obviously, if you're right and we get 25 in September, November and December, and then next year, I guess we get a few more. Where's the terminal rate fall to?
We have the terminal rate at 3.25 to 3.5. Part of the reason for that is, you know, we've long had a view that neutral is not quite as low as where people thought last cycle. I think that the market has reassessed neutral upward, and I suspect that the Fed is going to reassess neutral higher as well. It's already come up in its dot plot from 2.5 to 2.75, but I think they'll have a discussion over the coming year and wind up a little bit higher. I would also say monetary policy is not the only thing that affects the strength of the economy. Last cycle, we were grappling with these post-financial crisis headwinds that restrained demand. Now we have a very easy fiscal stance and very resilient risk sentiment. And those things have offset and diluted the impact of higher rates so that whatever the Fed concludes long-run neutral is, I think it will wind up feeling comfortable leaving the funds rate a touch higher than that, knowing that we can still operate at full employment because we have these other forces boosting demand.
Other forces. And David, on that point, what do you make of the move in the dollar, which I believe now is at a 2-year low? What does that tell you about what the Fed will do? And does that level of weakness make sense given what we're expecting in September?
I think while we're forecasting 25 basis point cuts, the market is completely justified in attaching some probability to larger cuts. I think the message that we heard from Chair Powell at Jackson Hole is that they are not going to be held back by inflation anxiety anymore, and that their tolerance for weakening in the labor market data has now run out, so that if we do see any further signs of softness, they probably would go ahead with a 50 basis point cut. So as that message has come through more and more clearly, as we've gotten some further signs of soft points in the labor market, you know, while my baseline is that everything will be fine, I think there is a plausible risk that the Fed might have to go a little more quickly. I think the market is justified in pricing that. That's probably driven the downward move in rates that we've seen and the dollar moves on the back of that.
David, do you think that we might get the full 100 basis points by December that most market participants are pricing in without the economy getting meaningfully worse? Is it either or could you get the perfect Goldilocks scenario?
I think probably not. I think you do need at least some sign of further softness in the labor market data for the Fed to deliver a 50 basis point cut. Historically, when the Fed has moved more quickly than 25 basis points, when they've done intermeeting cuts or, say, 50 or 75 basis point cuts, usually there has been some obvious crisis going on. And in the other scenarios where there hasn't been a crisis, jobless claims have been running closer to 400,000 than to 200,000, so that there was a sense of urgency that I don't think quite exists at the moment. So I doubt that we'll get the full 100. My guess would be that we get a series of 25s unless we get some further data that really makes them at least a bit more concerned.